So you've got Swiss chocolate, fancy watches, and the US stock market. How in the world do those things connect? Well, in late 2025, a wild story involving all three sent some serious shockwaves through Wall Street. It's a perfect example of how global politics can hit your portfolio, sometimes in ways you'd never expect. Let's get into it.
Seriously, think about it. A tariff on chocolate leading to a stock market boom? It sounds kind of backward, doesn't it? How could slapping a tax on things like Nespresso pods or a new Rolex actually end up sparking a record-setting rally? Well, that's the big puzzle we're going to solve today.
And this slide, wow, it just lays out the whole roller coaster ride, doesn't it? You've got the shock in one corner, August 2025, a surprise 39% tariff drops out of nowhere and everyone freaks out. Then, in the other corner, the deal. By December, that tariff gets slashed, a huge investment is promised, and just like that, the market goes wild. So the big question is, how did we get from that panic to the party? All right, so first things first, we got to understand the initial crisis. The whole story kicks off with this completely unexpected move that basically caught the entire world flat-footed and had investors heading for the hills.
And I mean, this whole thing happened fast. On August 1st, boom, the administration drops this bombshell, a 39% tariff on Swiss stuff. And by that same afternoon, the markets were already tanking. It took a few months of intense back and forth before we got the deal on December 10th, which, as you can see, completely flipped the script.
So what did that actually look like in numbers? Here you go. The Dow, the S&P 500, and especially the NASDAQ, they all took a pretty big hit. You have to remember, investors were looking at the highest U.S. tariff rates since the 1930s. That's huge. And with that came all the fears, rising costs, messed up supply chains, and maybe even a full-on trade war.
Okay, so after all that tension, a few months of it, we finally get the resolution. A deal is made. And this wasn't just about calming things down, it gave the markets a massive shot of confidence. So let's break down what was actually in this thing.
So it all starts with this one number, 39%. And that wasn't just a number, it was a punishing, painful levy. I mean, Swiss officials were saying it was threatening entire chunks of their economy.
And then, it gets slashed all the way down to 15%. Much, much better. But here's the really key part. They made the cut retroactive. That means companies got refunds for the extra duties they'd paid since mid-November. You can just imagine the sigh of relief from businesses that have been holding off on shipments.
So, what did the U.S. get in return for that tariff cut? This massive number. We're talking 200 times billion dollars. Huge Swiss companies, think Novartis, Roche, ABB, they all promised to invest that much in the U.S. by 2028. And with that investment comes the promise of thousands of new American jobs. This is really the heart of the deal, this tariffs for investment idea.
All right, so those are the big headline numbers. But let's zoom in a bit. What products and industries were actually caught in the middle of all this? This is where it gets real.
Yeah, we're not talking about some obscure industrial parts nobody's ever heard of. These tariffs hit brands maybe even love. We're talking Rolex and Omega watches, your Nespresso pods for your morning coffee, that fancy Lindt chocolate. All of a sudden, these things were facing a huge price jump in the States.
And you can almost hear the panic from the companies themselves. They called it a whopping 39% duty. I mean, this wasn't some small inconvenience. This was a major threat to their business in the American market, which, by the way, is their biggest single market for watches. So yeah, this was a big deal.
I mean, it's pretty simple, right? A nearly 40% tax makes these watches way more expensive for both the stores selling them and for you, the customer. And sure enough, while the tariff was in place, U.S. sales just plummeted. People just weren't willing to pay that insane markup.
But as serious as that was, the stakes were even higher when it came to pharmaceuticals. There was talk of tariffs as high as 100% on some really important drugs from Swiss companies like Roche and Novartis. The deal stopped that from happening. They put a cap at 15% and basically dodged a huge bullet for U.S. healthcare costs and supply chains.
Okay, so luxury goods are saved, a potential pharma crisis is avoided. Let's pull back out to the big picture and see why all of this made Wall Street so happy.
And here's the proof in the pudding. The day the deal was announced, the S&P 500 shot up 0.7%. That was part of a big rally that pushed the index to record highs. And for investors, this wasn't just about Switzerland. It was a sign, a signal that maybe, just maybe, the broader trade war fears were starting to fade. And it wasn't just investors feeling this way. The experts were saying it too.
Even before this particular deal was done, you had analysts like John Stoltzfus at Oppenheimer saying that this whole pattern of resolving trade fights was a huge positive for the market. His thinking was simple. When you replace all that what-if uncertainty with clear, solid agreements, you're basically giving stocks a green light to go higher.
And this feeling of relief was everywhere. The S&P 500 got a boost because confidence was back. The Dow, which is full of big industrial companies, loved that trade friction was easing up. And the Nasdaq, it was super relieved about a little detail in the deal that capped any potential future tariffs on semiconductors at 15%.
So, okay, the market rallied. We get it. But what does this whole episode really tell us about the bigger picture? Let's wrap this up with the main takeaways and what this could all mean for global trade going forward.
So what should you remember from all this? Well, first, this was more than just a one-off deal. It was a signal that things were cooling down in a pretty tense trade environment. Second, it brought back investor confidence by proving that these disputes could actually be solved. Third, that $200 billion in investment is a real economic stimulus, plain and simple. And maybe the biggest takeaway of all, this might have just created a whole new playbook for how trade deals get done.
And that leaves us with one last really interesting question to chew on. Is this the new playbook for trade? Using the threat of big, aggressive tariffs as a bargaining chip to get massive foreign investment? Is that the new normal? It's a powerful idea for sure, and it's one that could totally change the game for the global economy for a long, long time.